Right, Karanya, it's quite disappointing actually. The markets have definitely paused today, and it seems that now that nervousness regarding the upcoming US election as well as the delay in stimulus. We've heard stimulus talks on for 2-3 weeks now, but the next round is just not coming. And as it is, we were expecting 2.2 trillion. Now they're saying it's going to be more like 1.8 trillion. So I think that's caught up with the markets a little bit. I'm going to do a comprehensive check in just a second. But before I do, let's just bring up the BNSN quiz question for today. Our question to you, and we do have some people who've responded on Twitter, was which pipes player has the highest EBITDA margin? So your options are a very well-known company, Astral Poly. We then have Prince Pipes, Finolex Industries, and Indian Hume Pipe. So do have a look, check out the margins of all these players, and then do tweet to us on the ET Now official handle. And if you are one of the correct responders, we will be featuring your handle on the channel at 11:45 sharp. So that's a chance for you to show how knowledgeable you are about the market. So please do tweet to us regarding that question. But now coming back to the markets, and let's just get you a little feel for what the breadth's like this morning. Doesn't really matter which index you look at, the banking index, the auto index, the mid-cap index, every index is virtually down. Banks down a whole percent, auto down 0.3%, mid-caps down 0.6%, the Nifty itself down nearly 0.7%. The overall breadth today is definitely in favor of the declines. We have 36 out of the 50 Nifty stocks currently in decline. That means just 1/3 are showing a positive momentum today. From this 1/3 that I just spoke of, you have the Bajaj twins. Actually, you have a Bajaj trio this morning. You have Bajaj Finserv, Bajaj Auto, and Bajaj Finance, all in the top gainers list. Finserv gaining the most, followed by Auto and then Finance. We also have Titan and Tata Steel, two stocks that are standing out this morning. Very high volumes seen on those as well. Now, on the losing side, Wipro, very surprising candidate considering that they've announced a huge buyback. Perhaps people are a little unhappy with the price. I know 440 is what people were expecting. 400 is what happened. So that's currently trading at 350, down almost 6%. You have NTPC down 4%, Coal India down 3.5%, ONGC down nearly 3%, Power Grid down nearly 2.5%. So a couple defensives as well taking a beating today. And the flavor definitely trading more towards the bearish side this morning, Karanya.
Absolutely. Thanks for giving us a detailed check on what's happening in the markets, which is the stocks you need to focus on. Meanwhile, our guests have also joined in. Kunal Bothra on the technicals and Gaurang Shah on the fundamentals. Morning, gentlemen, and thanks for taking time out. Kunal, I'll come to you first. Should we read into the market with a sense of cautiousness or some kind of concerns at this juncture now that Nifty once again has halted its up move? Is there anything to be concerned about, or is it just a short-term blip?
So good morning, Karanya. After a 1,200 point move on the Nifty, in 10 days, I think there are bound to be these periods of odd, I would say, pause periods or retracement periods where you see the indices and many of the sectors and stocks which have rallied up higher. Many of these stocks and sectors, they would go through a natural correction. So I think that this is a natural correction, or I would say a much needed correction for the indices. Now there is one historical aspect to this rally for the Nifty. Now in the last 10 days we've been talking that how from 10,800 the Nifty has climbed by to 12,000 mark. It's almost a 1,200 point rally in a 12-day span. Now whether this was one of a kind rally in the last 6 months, no, we had a similar kind of a 1,200 point move on the Nifty when it had rallied from 8,800 to 10,000. I think it was in the month of May, April and May somewhere. Even after that point of time, there was a 50% retracement towards that 1,200 point rally, and then the Nifty managed to continue to move up higher. So even if you try and extrapolate that it could probably be a likelihood scenario on the same trend, then we could probably expect a mild bit of retracement further for the index, probably even 11,700 or 11,600 as well could be possible on the Nifty from a short-term view. But at least by the texture of the market rally and the texture of the stocks, it doesn't look like that it could probably be a major reversal, at least as of now. So I think one should probably wait for maybe another 100 points, 200 points on the downside. If someone is wanting to initiate fresh longs, I think that would be the best short-term strategy in the market so far.
Kunal, what about your high and low risk ideas? What stocks do you have for us today?
So I have two ideas, Karnya, and first one apparently is a sell idea. It's on Mindtree. Now yes, I understand that a lot of these IT stocks have been doing exceptionally well, but then what has happened is in the last 2 days, I think specifically yesterday, and for some of the stocks it was day before, many of these stocks have entered into their extreme overbought territories. Now there are flux of indicators, which indicate those overbought natures. It's not just the typical RSIs, but a whole host of these other indicators which indicate that there has been too much of an overbought nature of the stock price. Now, whenever we see these overbought figures on the indicators, we generally see a sharp reversal on the short-term chart. So I would expect a similar reversal on stocks like Mindtree. Hence, I would suggest that as a high-risk contrast sell. Targets to be kept at 1500, stop loss at 1600 mark. The second would be again, I would again commit as a more of a high risk trade. It's a buy on JSL Hisar, it's a mid cap name, Jindal Steel Hisar. Again, a very interesting stock chart. I think on some 3-4 time frames, the quarterly, the monthly, as well as on the weekly charts and the daily charts as well. On many time frames, the stock has confirmed a typical breakout. It's a flag pattern breakout. It's a swing pattern breakout, Ichimoku pattern breakout. So a lot of technical indicators which suggests that this could be another mid-cap name which can continue to move up higher. So I would expect that if this is a mild retracement in the markets, then I believe these mid-cap names individually, which have strong chart patterns, they would continue to move up higher. So again, term this as a high-risk trade. A buy on JSL Hisar, targets of 115 and stop us at 90.
Okay, thanks for that, Kunal. Gaurang, let's also get your picks in, high risk and low risk for this morning.
Thank you, Varun, and morning to all of you. So I think at 11,500, 12,000, everybody wanted to jump into the market. And with a small bit of healthy correction and consolidation, people are wary. I don't think you end up making decent return with this kind of an attitude. I think you have to approach the market with a little bit of more maturity. And given the run-up, it is always prudent to have some amount of consolidation and a little bit of profit booking. But the view on the market remains extremely positive. Buy on dips is the recommendation. And if you do get further dips, then two investment idea. First one is from an FMCG pack, Colgate Palmolive. I think what we have realized is that first of all, despite the competition from Patanjali and the likes of Dabur, the market share and penetration has improved to a great extent. And to compete with these Patanjalis and the Daburs of the world, Colgate has also introduced Ayurvedic products in the market, and that is gaining attraction. So long-term targeting 1750 on Colgate Palmolive. And the next one is from the NBFC stroke MFC, that is non-banking finance company, microfinance company. Credit Access Grameen is the second one. Both these are low-risk ideas. These are fundamental ideas. These are not trading short-term, medium-term ideas. So please bear in mind that before you make an investment, you should have at least 15 to 16 plus months kind of time horizon to make a decent return. And on Credit Access Grameen, given the penetration and growth in the semi-urban rural India, wouldn't be surprised to see stock heading towards 830, 850 mark. But staggered approach investment is advised given the kind of long-term investment ideas these stand for.
Okay, thanks for that, Gaurang. Great to get in your views. With that, let's now get to our queries for this morning. And our first one is from Riddhi Bichu of Bombay, and she has bought granules recently, and she's now made around 12% return in granules. She'd like to know that while the commentary is very strong from the management, there's a lot of skepticism about the stock and perhaps the past history. So she'd like to know if she should stay invested, add or hold. Kunal, coming to you first. On granules, do you think 12% return at current price is a decent enough cause to book out?
Well, yeah, I think if it's a shorter term investment, then I believe that's a good enough time to book out. And also, I think Varun, the stock has run exceptionally well in 6 months from 140, 150 levels. It's almost touched the 400 marks with return of more than 2.5 odd x. But the stock trend on the long term basis is still very, very strong. So I think it all depends on the, I would say the time frame, the risk appetite of the investor, of the viewer. So I think if it's more towards short-term approach, then these 12%, 15% would be good enough target ranges from a short-term view. And if the markets go into a bit of a corrective phase as well, there's always a possibility that you might get these stocks back at their lower in the support levels. But I think from a longer-term view, what happens is when you see these stocks moving into a strong uptrend in a short period of time, 2x, 2.5 or the x return, that generally sets the tone from the long-term basis for Granules. So I would suggest that short-term pain, but I believe in the long term, if you have a holding period of the next 1 to 3 years, then I believe a much stronger return on the upside would be possible for a stock like Granules.
Okay, great, Kunal. Thanks for that. Gaurang, what's your view fundamentally? Firstly, why does Granules trade at a discount to a lot of the other pharma players? And I mean, I'm sure you're up to date with the latest commentary. It's so bullish. So what do you think? Should she stay invested or book out or possibly even add at current prices?
So Varun, I also heard about the investor being concerned about the past history of the company Granules India. Well, we've been maintaining a positive stance for a pretty long time. And after the stock consolidated between 260 and 300 for a pretty long period of time, and that is exactly the time when I think we got a couple of positive news on Granules India with the approvals for certain products that they had launched both domestically and globally. And from there onwards, once it broke out of that 260, 300 zone, I think 400, 380, 400 is what we saw on the higher side, 400 plus if I'm not mistaken, and I stand to be corrected if I'm wrong. Yesterday we saw 400 plus. So we remain extremely positive, yes, but the only worry is that the stock has run up in the last 2 months to a great extent, from 280 to 400 plus. So maybe there might be a brief period of consolidation, but on the earnings front, we remain extremely positive. She's got long-term time horizon, and in equity market, you always need a little bit of higher risk appetite. So if she's got both of them, stay invested.
All right. Okay, then moving on to our query number 2, which is from Vidhi Shah. She's based in Mumbai and she wants to invest in Bandhan Bank at the current price. She has been tracking the developments, it seems, because she's mentioned in a question that the bank has posted a strong Q2 update and collections were at 92%. So she wants to know both fundamental and technical view of our experts. Kunal, starting with you, Bandhan Bank, given the recent run-up it has seen in its price over the last 2-3 weeks, is it a good idea entering at the current juncture or should she wait for dips?
I think it's a good idea to start nibbling at these levels. Karanya, because I think almost a year and a half back, the stock was at 740, 750 rupees. You saw a sharp correction. The stock came crumbling down to almost 150 rupees, and then from 150, this was one of the few banking stock which managed to more than double itself from those March bottoms. So the stock has shown very good recovery in the last 6 months. And then typical to the stock price patterns, after you see the stock moving up higher with returns of 2x odd, you see these stocks consolidating, going through a bit of a volatile range, and it tends to shake off a lot of the weaker hands. So I believe that the shake off process is still going on for stocks like Bandhan Bank. But this recent, I would say 1 week back or 2 weeks back, I'm not sure exactly on the time frame, but a week or two odd back, the stock had broken back above its 200 moving average. Now that was, I believe, one of the important, I would say, technical breakouts which had happened for Bandhan Bank, and that came after almost 1 year of the stock trading below this critical level. So I think on all price aspects, on many of the indicator fronts, the stock is trying to show a lot of positivity. I would suggest that the viewers should be looking to buy Bandhan Bank or at least start buying at current levels, and if this and try and use this volatility or this shakeout which happens to try and average out further and then hold it on from at least a medium term to long term perspective.
Okay, and Gaurang, what about the fundamental view on Bandhan Bank? How does it look at this point in time, given the way it has been performing, the valuations, and how it's placed, vis-a-vis its peers?
So Karanya, this particular investment idea comes with a caveat. Though it is a private sector bank largely concentrated on the semi-urban rural India and spread more over its network in northeast India. The recovery is quite strong and is quite heartening, but the problem is that a lot of investors have got stuck into this stock at a higher level. So you may see profit booking or supply coming in at every 4-5% up move. But we are quite confident that the commentary from the management will withstand and it will reflect upon the numbers not only in the second quarter but for the third and the fourth quarter this financial year as well as for the next couple of financial years. But like I said, this bank investment idea comes with the caveat that you need to have a little bit of elevated risk. If you don't have that, then ICICI and Axis Bank are something that you should possibly look at because they will have a lower risk appetite and a higher rate of return on investment. I'm not saying that on Bandhan Bank you will not get it. You will get it, but you need to have an elevated risk appetite. So if you have that, definitely go ahead and invest. Otherwise, Axis and ICICI Bank would be the preferred destination.
All right, there you have it, the verdict on Bandhan Bank. Thank you so much, Gaurang and Kunal, then for joining in with your views and with your take on the various queries that we had. Before we slip into a break, here's a quick snippet of a conversation we had with Mr. Aditya Narayan earlier in the day. He says that IT sector is at the beginning of a multi-year run and the big wave will help the small players as well as the big ones. Listen in.
Our biggest and most structural call remains with the larger IT plays. We think that is something that is going to sustain for a reasonable length of time. We are at the beginning of a multi-year run and we are really calling it a decollution, which is really something that we think the economy will fundamentally play along. I think at the second level, you then have the second tier IT stocks, which again, we think from a nearer term perspective will have a decent amount of momentum because, when you have a big wave, the smaller guys tend to incrementally at least gain more over the near term. So I think there will be a certain amount of meat and muscle there too. I think if you drill it down further to pure, domestic internet stocks, they've done well. I think they will continue to hold, but they've had a very, very strong run. And there I would say one can expect a little bit of leveling off simply given the amount of stock performance that they've had. But I think if I were to step back, I think the very good thing from an Indian market perspective is that, this is after a long time that there's a sector in India which is catching a global demand surge, right? And I think this is going to go on for a fairly extended period of time. I think the supply side gets better with this work from home phenomenon where costs can be kept under control. So I think IT globally is going to do well, and I think the Indians are very, very well positioned to piggyback that.
Hello and welcome back to Buy Now, Sell Now. Let's get you our quiz question once again for this morning. Which one of the following pipes player has the highest EBITDA margin? Your options are Astral Poly, Prince Pipes, Finolex Industries and Indian Hume Pipe. Drop a little hint for this question. It's a very close comparison between two players. Please go tweet to the ET Now handle, tweet your response and you can get featured at 11:45. But on to an ET Now mega exclusive. Globally or domestically, there's only one thing which is currently driving markets up, and that is stimulus and liquidity. Rumors, or not really rumors, well, our sources, ET Now sources indicate that there is another massive stimulus package currently in the works from the Indian FM's office. Nayantara Rai, my colleague who broke this story, is now joining in with the details as to what this package could really mean for us and how big the relief could really be. Let's listen in.
Never say never. As we speak, the Modi government, the finance ministry are evaluating more stimulus for the economy. There was a perception that maybe we're done before Diwali, but all options still very much on the table and being evaluated. We tried really hard to ascertain that would the new stimulus be targeted at sectors. Would it be for individual taxpayers? Would it be for the salary class in the private sector? Unfortunately, we've not been able to ascertain that. 48 hours ago, Finance Minister Nirmala Sitharaman did, announce stimulus for central government employees, a sort of a scheme involving cash vouchers against leave, travel, conveyance, to try and prop up demand, bring consumption back, all of that. We're now being told by our sources that 48 hours ago, during the fiery GST Council meet, the centre actually urged all state finance ministers to also follow the centre and announce a similar scheme for the all state government employees. Now, Nirmala Sitharaman had also announced a 10,000 rupee advance, festival advance for all central government employees. And in fact, we are told that the GST Council, she made a case for the states to also come out with a cash advance scheme for all state government employees. So that's going to be something very interesting to see if it does happen. We also checked with the government if the private sector would come out with a similar scheme. If you and I, for example, would enjoy such a scheme before Diwali. So far, no corporate and no one from the private sector has assured the Modi government that they will be following suit.
Thanks, Nandara, for that. Let's get you some more ET Now exclusive. We learned from our sources that the government is likely to come out with a privatization policy in a span of the next 2 to 3 weeks. It should come up before the cabinet while the policy is ready. Feedback from the ministries is being sought. This policy will also include the privatization of public sector banks, and the government is likely to also name the strategic sectors under which the government will retain up to 4 companies. So what can we expect? Are there any particular names that Ruchi has been able to garner for us? Let's take it across to her to find out.
Well, revenue is definitely on the mind of the Modi government this evening, as the government is looking to move fast on the privatization policy. Once again, we at TT Now are given to understand that the privatization policy could be taken to the cabinet in the next 2 to 3 weeks. We're given to understand that the draft privatization policy is already ready, and DIPAM has received feedback from other ministries as well. Remember, under the privatization policy, a larger, a broader policy will be worked upon, under which the government will list out strategic as well as non-strategic sectors. We're also given to understand, as reported by ET Now earlier as well, that under the strategic sectors, the government will retain up to 4 public sector enterprises. Among the strategic sectors, the government is likely to name sectors such as the public sector banks, oil and gas, mines, minerals, insurance, that will come under the purview of strategic sectors. Under the non-strategic sectors, the government will completely look at doing away with any companies, their stake in various public sector enterprises, mostly going to involve sectors such as aviation as well as hospitality. Having said that, this policy will by and large define how the government is going to proceed with their privatization plan in the days to come. But all in all, the plan is ready, the policy is ready, and it will get a cabinet nod in the next 3 weeks or so.
All right, that was a very interesting excerpt by Ruchi. But Jayesh is standing by, and he's been doing some interesting analysis on how the AUMs of various multi-cap funds have changed in the last quarter or so. Let's cut across to him.
First and foremost, let's have a look at the best performing multi-cap schemes that we have for this year itself, starting off with the PPFAS long-term equity fund, which has delivered more than 20% return for its unit holders in 2020. Not many multi-cap funds have in fact been positive for this year. You have UTI Equity Fund along with Canara Robeco Equity Diversified Fund, and lastly you have the Tata Multi-Cap Fund, which have gained about 1% to 7.5% each. However, on the flip side, there's been a lot of losers as far as the multi-cap category is concerned. You have the Nippon India along with the HDFC India Equity Fund and the ICICI Prudential Multi-Cap Fund, which have declined more than double digit for this year itself, along with the IDFC Multi-Cap Fund and the SBI Magnum multi-cap fund, which have also declined about 6 to 7% each. But ever since the recategorization announced by SEBI, it was anticipated that you will see a lot of outflow from the multi-cap category, but that has exactly not turned out as per script, though there has been a decline in the AUM itself. You have the HDFC India Equity Fund that has lost more than 1300 crores in worth of AUM, while you have Franklin India and Nippon India that have lost more than 500 crores AUM in the last 1 month itself. And then you have the ICICI Prudential along with the Motilal Oswal multi-cap 35 category, which has lost anywhere between 200 to 400 crores. And then you have the likes of SBI Magnum along with the Aditya Birla Sun Life Equity Fund and the Kotak Standard Multi-Cap Fund, which is the largest multi-cap fund that we have in India, which have lost about 160 to 200 crores. And you have the UTI Equity Fund that has in fact gained 400 crores worth of AUM as far as the multi-cap category is concerned.
Thanks, Jayesh, for that. Slipping into a break here. More updates lined up on the other side. Stay tuned. Welcome back. You're still watching Buy Now, Sell Now. Let's address the big heavyweights from the IT space, Wipro as well as Infosys. One delivered its numbers yesterday. The other one will be giving out their numbers today. Let's take it across to Poonam to first talk about how Wipro numbers panned out. How's the street digesting those numbers and the commentary? Poonam?
Well, while Wipro did give a very strong Q3 guidance, the results were largely in line with the estimates, and the buyback announcement of 9,500 crore at an attractive price of 400 was announced. Having said that, quite a few of the brokerages although they have gone ahead and hiked the revenue estimates ahead, some of the brokerages still maintain a sell on account of high valuations for the stock. In fact, Goldman Sachs does state that they're maintaining sell with a target of 277 per share. Stock is trading at 12-year high valuations according to them. Results are in line, and with the new strategy rollout, they do believe that the valuations are exceeding fundamentals of the stock. JP Morgan maintains underweight with a target price of 270 rupees per share. They have gone ahead and upgraded the revenue estimates by 2 to 5% over FY21 to 23. They're stating that solid execution is there, strong guidance for Q3. Strategy changes are sensible but still gradual. Motilal Oswal also has a similar story. They have gone ahead and upgraded the revenue estimates, but they're stating that they would want to wait some more time before turning constructive on the stock, because they would want to see the successful turnaround of the overall strategy. So all in all, yes, the stock is down. Nearly around 6% is in trade. It is, of course, trading at high valuations, and of course the stock had run up considerably even ahead of the results, like most of the IT players.
Thanks, Poonam, for that. Meanwhile, we also await the performance of Infosys for the quarter gone by. As far as the expectations go, we're expecting dollar revenue to grow 4.2% on a sequential basis, coming in at $3,252 million. Revenue is seen at 24,163 crore rupees, up 2% QOQ. As far as margins are concerned, what we're factoring in is a 20 basis points growth on a sequential basis at 22.9% versus 22.7% in the quarter before this, which is Q1 of FY21. So yes, the revenue in CC terms is likely to grow nearly 3% sequentially. We expect cross-currency benefit of close to 155 basis points. EBIT margin also to show moderate expansion, like I just flagged off. Improvement in utilization and operational efficiencies are likely to offset the INR appreciation. We also expect strong deal momentum as well. As far as the guidance is concerned, Infosys may hike lower end of the revenue guidance to 1% to 2%. That's the range, something that the brokerages are factoring in right now. Any buyback announcement, capital allocation, M&A, deal momentum, tenure, pricing, these are some factors we will be watching out for. So this evening, Infosys will be the cynosure of all eyes.
Right, it's definitely IT week here. in the markets. We've had 2 majors. We'll now have some more. And then, of course, it's IT always that leads earnings season, and then you have banking. Talking about banking, though, and financials, the next stock I'd like to flag off is SBI Card. And there's a reason we're mentioning this on Farafat today. It's because spends have completely recovered to pre-COVID levels. So in March, we had credit card spends pan-India for around 50,500 crore. What we then saw in April, May, June, and we caught up with the MD of SBI Card at that time, who was Hardayal Prasad, when the revenues had considerably fallen. They slowly recovered to 60%, 70%. Now we're back. It's almost as if nothing happened. YOY, 50,311 crores is where we stand today. So SBI Cards obviously is one of the largest beneficiaries of this trend. HDFC and SBI Card really lead the credit card market. Then you have everyone else after them. So those investors and that particular counter should definitely cheer this news. But obviously, once the results are out this quarter and we see how the company financials have done, we should have a much better idea of how these increased spreads have really translated into better revenue and profits for the company. Back to you, Karanya.
Right. Let's start off our market fatafat then by looking at some more stocks that are buzzing in trade. Karnataka Bank doing fairly well in an otherwise, lackluster market in today's trading session. The stock is up almost 4% as we speak. They delivered the numbers yesterday. NII saw a healthy expansion. It's come in at 574 crore rupees versus 498. Profits have also grown at a smidge. 119.4 crores is what they've delivered for the quarter gone by. There's been a good compression in the GNPAs as well on a sequential basis from 4.64 in the previous quarter, which is the Q1 of FY21. This time around for Q2, their GNPA stands at 3.97%. NNPA has also gone down from 3.01% to 2.21% QOQ, and so have the provisions actually. If you look at the QOQ situation, in Q1, the provisions that they had registered were at 509 crores, and for this quarter, which is Q2, they came down to 322 crores. However, on a YOY basis, they still continue to be a bit high, I'd say. But that's the verdict on Karnataka Bank's Q2 performance. The street is also giving it a thumbs up. The stock trading at 44 rupees a piece. Next stock I'd like to address is Tata Steel. That one also is doing comfortably well in a weak market. Morgan Stanley has come out with a note as well on Tata Steel. They've maintained their overweight rating. The target that they've given is 565 rupees a piece, which is a very, very solid upside if you look at the current market price, which is of close to 370 rupees. They say that Tata Steel Long Products, which is a subsidiary, it reported strong EBITDA performance. They beat estimates thanks to stronger than expected revenues as well, and strong cash flow generation in the first half has helped lower the net debt for the entire company as well in the first half of this fiscal. So these are some key triggers they're flagging off, which are making them retain their overweight stance. Varun.
Yeah. Overweight stance, like Karanya just said on Tata Steel. It's time to address the quiz question though for today. And I don't know how many people have got it right at the current juncture, but our question to you is, which of the following pipes companies had the highest EBITDA margin? And the answer is Astral Polytechnic at 17%, followed closely in number 2 by Finolex, pretty much at 16%. Prince Pipes, again, not too far behind, and the lowest was Indian Hume Pipes. So I believe we have one person who got that right today. I can't see their name on my screen, but it should be flashing on yours. So congratulations to our winners of the BNSN quiz today, and we'll be bringing you more and more of these questions in the days to come. Please keep participating.
Okay, let's get you the Nivesh Ke Funde segment for you, wherein it's Times Network Initiative, of course, wherein we tell you how to better invest your money, how to make the most of your savings, of your investments, etc., by decoding a few fundamental jargon, a few fundamental concepts in the market. So let's see what we have for you today. Take a look.
Today we're talking about asset allocation and diversification. It's actually a crucial part of managing one's finances, but one that's often overlooked.
You're right. And while mutual funds are a great vehicle to achieve optimum asset allocation, one particular type of fund is more ideal.
You mean the multi-asset funds, right? These funds are incredibly efficient for an investor to manage their assets because they allow investments into mixed assets like debt, equities, cash, gold, and so on.
Yes, Abha. And the biggest plus point is the seamless asset allocation composition between the different asset classes, depending, of course, on the market situation.
Yes, exactly. Most investors prefer to invest in limited asset buckets because they're either comfortable with those assets or they feel those assets are the ones that will give them best returns over a period of time.
But you know, the performance of asset classes as well rotates. It rarely happens that one particular asset class consistently tops the charts every year.
Exactly why ensuring diversification in your asset allocation is incredibly important.
And as the age-old saying goes, don't put all your eggs in one basket. That's all on this edition of Nivesh Ke Funde. Do stay tuned for many more such investment insights on the Times Network.
Okay, let's also get you an excerpt from a very exciting conversation Mubina Kapasi earlier had on the Money Show. Listen in.
Well, as far as any gold investment is concerned, whether it's through SGB or it's through gold ETF, I think the point to keep in mind is what is your asset allocation and where does this really fit in your asset allocation? So are you over 20% invested in gold already? Then probably you don't need to take more exposure. But certainly if you are under allocated to gold and you would like to take more exposure given what we've seen happening in gold and given the short-term prospects of gold, certainly, you can take an allocation to the sovereign gold bond scheme, but clearly it has to be based on your asset allocation and the fact that you can hold it for 8 years.
Okay. Would you stick to your earlier given recommendation that, of course, based on allocation, I totally get that, right? You should put maybe 5 to 10% of your total portfolio in gold. However, let's say if somebody does not have this investable way of gold, I'm not talking about the jewelry that lies in everyone's homes, but all of these paper forms of gold, which are used for investment. If let's say someone has not yet reached their 5-7% target of asset allocation and they want to use this SGB to do so, do you recommend they lap it all up at once in this tranche or again stagger it?
Well, actually, that's a little difficult to say. I mean, certainly the gold is looking good over the next couple of months. So I think the next tranche is going to be in November. And certainly, given that the festive season is coming in and seeing the quantitative easing that's there across the world, especially the US, I think, in the short term, probably the prices might move back up. Certainly, we had like a 7-8% correction over the last couple of months. But I would always say that, yes, you can put some amount right away, but it's a bet always, I mean, you never know what it can really go to, what can happen in the interim to move the gold prices. So, but yes, it's not a bad idea. And there is also some discount if you're going to buy it online and everything. So it's actually working out to, I think, 5,000 rupees per gram that you're buying it. So it's not a bad idea to take the allocation right now. Considering that there has been a little bit of a cooling off on the gold prices.
And meanwhile, Manish Gunbani spells out the mantra to get rich. Listen in to the simple, time-tested advice to get to those millions that you have been dreaming of all along. Let's listen in.
if you ask on a 10-year basis, the kind of stocks which will work are something which will ride the technology wave for sure, because it's very difficult to engineer top line growth with an offline model at this point of time. So yes, while these tech stocks and the digital oriented stocks are very expensive, they're done well, and they may go through a crash like 2000. But the point is that if you go back to that area, period, Google or some of these stronger names actually emerged through that crash. So yeah, I mean, clearly the big money from a 10-year basis, it's very difficult to make without some IPR or a network-centric business model. Unfortunately, in India, a lot of that action is happening in the private equity space, not in the listed space. But I'm sure we will get opportunities. The other way is, of course, I think some of these healthy secular growth industries like banking, general insurance, retailing, periods like this year hopefully give you some chance to get in. And a lot of these businesses also should, some of the good businesses or good managements in the sector should grow 15, 20, 25%. But yeah, if you're looking to make, 10x to 100x, I think it will have to be a bit of a technology-oriented play.
Okay, switching gears a little bit, the festive season is upon us, and so is the season of discounts and bargain hunting. What we've also seen is a massive pickup in auto sales. So as a result of that, and specifically let me add in the 2 to 5 lakh segment, those are the cars which are seeing the largest uptick. So we caught up with the co-founder of Cardeco, Amit Jain, to understand the current scenario and what to expect from the sales this festive season. Let's listen in.
We are going to be opening not 50 but 100 odd stores by March. So 100 opened by March of this year, while we end the financial year. And the plan is to open like 1,500, 2,000 stores over the next 2 years, right? So with that intent, we are basically building this vision out and making car used car buying a hassle-free experience. You also get
100 new stores by March. Are these going to be in the big cities? Are you going to the smaller cities? Is it going to be, can you tell us a little bit of that plan?
So, Nayantara, the idea would be that we'll first go into large populated cities, which 100 would be primarily in top 20 cities, right? And when I talk about going to 1,500, 2,000 stores, yeah, I really mean we are going to Bharat then, right?
Okay, so you'll go to Bharat in the second phase. Now, Amit, you said that car sales are starting to boom. Can you give me a little idea and back that up with data? We've seen in, for example, the primary car sales by the OEMs, there is a pickup in activity. Are you saying the used car market is in top gear? How many, for example, vehicles did you sell in the last month? What kind of an increase did you see?
So basically, the way to look at it would be what is first the online trend of how many people are looking for used car online. So we see almost a 30% increase over last season, right? So clearly, there are more buyers online who are looking for used cars. That's 30% more. Second thing that to notice is where are these demands coming from? So when I split the demands into various segments, there is a significant rise in tier 3, 4 demand. Like if it used to be pre-COVID X, it's already 3X, right? So there has been a good Rabi crop. So many people who dependent on the agriculture sector are basically buying vehicles, right? And used and new both are up, by the way, in these 3, 4, 5 segments, tier 3, 4, 5. There's clearly a good demand coming from that. And on the metro side, people who would earlier go by the metros or who would use Ola Ubers are not taking up a vehicle for their personal safety. So there's a clear pattern, and the demand is up here also, by the way, on the the metro side, on the top city side also. So we can clearly see a remarkably good increased demand right now. In fact, what we also calibrate the fact from is our Gadi stores. We are already doing more transactions than pre-COVID on the Gadi stores. That also, kind of builds confidence on, how things are moving up. We're already doing 20% more transactions than what we would do pre-COVID earlier, right? So that's also working well, clearly. So all these factual data points, when I collaborate with each other, clearly tells me, we're in for a very good season on Diwali and the share of both. Both October and November are going to be great.
With that, we're wrapping it up on the show. Thank you so much for tuning in.